Will investors see a Santa Claus rally or a Santa Claus slump into year-end? Mona Mahajan, Edward Jones, senior investment strategist, joins us now. What do you make of that breath issue, Mona?
Yeah, look, we've had a great run in 2024. The S&P's up about 27%. Are we surprised to see a little bit of pullback volatility? Keep in mind, this is year end where folks are thinking about rebalancing, repositioning, tax loss harvesting. To us, all of that aligns to a market that may be taking a bit of a breather, but we do think momentum is on our side. That Santa Claus rally tends to happen in that week after Christmas through New Year's, and we think that could certainly still be a possibility as we head to year end. More broadly, we think the fundamental picture remains intact. This is still an economy that's not showing any sign of recession. This is still a Fed that is moving rates lower. And we do think inflation remains contained broadly. This week's data confirmed that as well. So we think the fundamentals are strong. That still calls for a continuation, or at least the underpinnings of this bull market remain intact.
So I showed this chart earlier about inflows. U.S. equities logged $186 billion worth of inflows over the last 9 weeks, largest inflow on record. I mean, money is flowing in post the election as the Fed cuts. How much more do you think there is to come in from the sidelines, whether it's from cash, from overseas? Here's the chart. It's pretty stunning.
Yeah, a couple of things in play here. One, we know about that $7 trillion or so sitting still in money market funds. And secondly, this has really been a year and perhaps continuation of the U.S. exceptionalism story. So this is a confluence of a U.S. domestic economy that continues to perform, and we're seeing that play out in domestically oriented parts of the market, like not only large caps in the U.S., but mid and small caps in the U.S. And part of that cyclical value story is also driven by that U.S. exceptionalism as well. So we expect more of that in the year ahead, certainly. And we do think as investors start to think about 2025 positioning, yes, we continue to like, and they continue to like the AI mega cap technology theme. But I think that exposure to those parts of the market that have scope for valuation expansion, that will see better earnings growth ahead, and that will benefit from Fed and global rate cutting cycles, those will also play some catch up and continue to play some catch up. So diversification theme, broadening of market leadership, we think the flows head in those directions in the year ahead.
Mona, you mentioned inflation being contained. I mean, PPI did run hot. Headline CPI was the biggest month-on-month since July. The 3-month annual rate on core is hotter than the 12-month. How much of a risk is behind that statement?
Yeah, look, I think the inflation story heading to the Fed's 2% target and staying there is a tougher one. But the contained story, perhaps inflation remaining in this 2 to 3% range, is one that we could get behind. And one thing to note is it's not only inflation, absolutely, it's relative to what folks are getting paid. And this year, what we really saw continuing from 2023 is that wage growth outpaced the rate of inflation. So folks were taking home real wages that they could spend, and we continued to see a consumer that hung in there. We think that story continues into 2025. We think wage gains will continue to exceed inflation rates, which we think will remain in that 2 to 3% range, even with some of the uncertainties around whether it's tariffs, deregulation, the tax cuts, et cetera. We still think inflation remains contained, but more importantly, wage growth exceeds that inflation rate.